Share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to like, share, and these videos. So let's get into tonight's video. Well, welcome everyone. Had a nice long weekend. I got in a little early, so I was able to get a newsletter out last night. I'm glad I did. One of the things that I did go into last night, I apologize for the Substack last night. I went into a little bit of a rampage on the Trump administration and how they're handling all of these deals, so-called, I'm doing air quote deals. I continue to argue that the UK was not a deal. It was a couple of things agreed upon, and they called it a deal because they called it a deal doesn't make it a deal, right? There's plenty of things to negotiate there. I'll just air out a little bit here. Is my biggest complaint is how things are being handled, and we have some amazing people. In my opinion, I wanted to work for Howard many years ago. I'm glad I didn't, because I would have been in the towers that morning. But the point is that we have seasoned market people. Scott Bassett, we got Howard Lutnick, Trump. There's a reason why the markets are structured like they are. There's a reason why I put out on my Monday's newsletter the schedule of events that are going to happen as far as releases from the government agencies that we follow and look at the reports to address what we think is going on in the economy. These things are scheduled like they are so that we can all know they're coming. We're not going to get blindsided by anything, and all of a sudden they show up, hey, tomorrow we're going to do this, or we're doing it right now. And what's happening with the Trump administration, we had, a great 2% day today. So, maybe it's working. The markets are responding to it. My argument is that I want everybody in the stadium when these things are released, meaning everybody's present, liquidity's there. There's absolute opportunity for the forces, both positive and negative, to play out, and with price discovery. And what we're seeing is we saw this basically Trump telling us that, hey, the EU situation, well, we're not going to charge them 50, we're going to back off on that so we can negotiate. And this has been the tactic that we've seen: threaten but never do anything, and then back off, and then a couple parts of the deal gets done and it's celebrated as a deal. And so I have a lot of problems with what's going on, a lot of frustrations around that, just from a market participant standpoint. I don't want to get blindsided on Sunday afternoon as Trump's getting off an airplane somewhere and says these things before any official releases. So I would just be on record saying they should schedule Tuesdays, Thursdays, any day they want as releases, and talk about what's new in here so that we don't all get blindsided from these things. And it really sets the tone for a lot of volatility and more capital destruction than it does good. Even though the markets ended up 2%, it only takes the wrong player to have the wrong position on when one of these things happen, and it blows up everything. So I'm done. Okay, I'm finally, maybe I'll say I've got this out of my system. So let's go to markets. Market's pretty impressive. We're up at 59.34 right now. It was interesting. There's something else going out in the world right now. Is Claude is down. The AI is down for the last hour and 20 minutes plus. So I was going to run the sheets. This is one of these things that we learn about, always depending on a third party to get your information. I can tell you, we've run software for years, getting data, and from our data vendors. The only time we've ever failed, twice, in fact, in almost 30 years, that we failed in getting our product out to the market wasn't because we weren't ready, because we couldn't, our data vendor had an issue. We've had a couple issues like that over the years, and fortunately, and that's very disruptive. So whenever you depend on a third party, you can get into some issues. And right now, a whole lot of people have issues because Anthropic is down, and hopefully they'll get up. I'll check it. I wanted to run the sheets like I always do every night, and I can't run them. So we'll do this the old-fashioned way. But I just want to point out that these markets continue to climb. We're at 5,900. The old high's 61. I was on record a number of weeks ago. I didn't think we would be here. I thought we would stall around 57 or so, and we continued to climb. We started to see this pullback starting. Database started to, on a short-term basis, started to pull back a bit. We're starting to see some rotation happen, and then we get this news, and it bounces back. So, like I said, I'm frustrated just because anytime you have any intervention from whether it's reports or the Fed coming up to the meeting and those things happening, all of those things become influences in the markets that are going to disrupt normal flows. And it's kind of nice. We don't really have that opportunity anymore to see trends evolve because of earnings and all those things that people tell us it's about. Well, in the end, it's not as much about that as it is about all the noise. And right now, the volume is turned up to like 8 or 9 from the Trump administration, and they're just letting it blast. They don't care that the neighbors are screaming, "Turn it down," right? So they're keeping this up. I suspect it's by design. I don't like it, as I just said, but these are things that disrupt a lot of flows in the markets. Right now, the markets are accepting this as a good strategy because like I said, we're trading 59.40. We were down in a 57 handle, all of a sudden back up, get a big day. We got an RTXL signal, a lot to talk about today. We'll go through the database. I've already glanced at it. We did get some traction back on the dailies. The weeklies went over some metrics that I'll go through here in a minute, and I covered in the Substack last night. So I thought I was going to do a shortened version of the Substack, and I think it ended up to be like 4,200 words. So I apologize for the length as well. Hopefully it wasn't TLDR. Too long, didn't read. But there was a trade that came out. I just want to mention this last night. And, these data sheets are very important. They've become part of my life. I'm sure the boys over at Claude are working hard to boys and girls are getting ready to get this thing back up anytime. I'll check it here in a minute. Hopefully we'll be able to run the sheets while we're doing this. But the point is what we're seeing in this switch in the world, and dependencies are switching as well. So there's going to have to be some disruptions. This disruption, whatever's going on at Claude, ultimately is good. Why? Because they've got to figure out that to make this not happen again. Hopefully it's not a systemic issue of some sort. They just rolled out new models recently. So I'm sure it's kind of scary over there, them trying to figure out how to get the water running again. Let's talk about as far as, let me put something up here on the other screen. So bear with me just a second here, because there are some things I wanted to discuss. Normally I have this a little better organized, but we'll go from here on this. So this week, I just want to talk about a couple of things that we need to be watching out for. We are going to get the FOMC minutes on Wednesday, GDP second estimate for Q1. The deflator, I don't think any of these things are going to happen, are going to be much. That's Thursday. Initial claims, we're getting, that thing is like a meter stuck. We just don't get any changes. We got some home sales, some pricing information on real estate. That's going to be material. That's Thursday. And we also get, we had housing price index and some other things come out today. I don't even think anybody was looking at this stuff here. So what we're looking at from the standpoint of what's likely to happen this week, we're possibly pretty close to still stalling, because I'm going to show you some things that are coming out of the algos right now. We're going to go through daily, weekly on S&P and the NASDAQ after we go through the database. So let's go ahead and flow through. The room's filled up pretty good. So let's go ahead and get into some of the stats here on the database. So some interesting numbers coming out. We're looking here at the 65.94. I was expecting us to get down to maybe 58. We still could, even though the market, whenever you have a day like you had today, what you get a lot of is I call it sort of the flavor of the day, and the flavor was pretty strong. You got a 2% day. So it kind of carries over at some level, and that's what we're likely to see, a bit of residual bid in the markets, things of that sort. The database here, we got basically 1,050, maybe 1,070 new buys. Exits, we got about 200, just a touch under. So the ratios on 3-2 were bullish, but we pushed back up just a touch to 65.94% bullish. And these numbers, these metrics, 62 to 58 is kind of a support zone. And if we break below 58, then we start to get a little more in a short-term correction. But right now we're hanging above those numbers. I expect they will continue to stay above those numbers. There's no reason to expect different. I'll show you the patterns, although we're at a place where we still are pivotable, even though we printed back up to this 59 level. The last couple of times we got above 59, did not want to stay there. And I'll go through the technicals here in a minute on the S&P to talk about what's setting up there. But the bottom line is these numbers are pretty solid as we look at them. There's not a lot to be determined. We're just want to point out, let me see if I can get this at a right scale so that you can see it. The base, let me get off screen. Yeah, so look at we've got basic materials. That has been on for 24 days, 22, 19. So normally about 34 days, and these are market days, so that puts us into 2 weeks from now. Most of these indexes are going to be hitting maturity almost simultaneously. If you look here, they're pretty much all between 18 and 24 days. So at the end of the cycle, not this week, but the week after next, we're going to start to get a little frothy from a sector standpoint and maybe get rotation going on there. And so I think our next Fed meeting's in June, I think the 18th or something like that. But so everything's kind of moving through. We've got earnings behind us. We've got all this stuff is coming behind us now, and we're back to the noise out of the White House that I'm complaining about. And like I said, I just want to see better handling of key market information that is likely to move markets. There's really nothing here. You can see here, I've just moved over, see where my cursor is. The average days long in this daily model is 39, and that's on an overall database of all 14,646 symbols. So that is continues to be, we're right at 65% on the symbols. We're 75% long on the sectors, and 66% of all of the groups are long at this stage. So before I move off of the database, I just want to say this is pretty typical of a middle range. database. There's a sheet that I put in the Substack every night. It's basically I'm in the process of completely rebuilding WaveTech, and those of you that have WaveTech, we're going to have these Claude scripts, we'll call it, that you'll be able to plug in and take a couple small components, literally screenshots, and put them into Claude with this code, and it's going to generate. One of the things I'm building into the new software is intelligence, meaning that it's got Bob Kendall intelligence. So what I'm going through right now, I have just went through and described all of these different sections of how these metrics work, and then I've also done some validation through some of the database and having AI go through and validate that these trigger points against the S&P and so forth have been valid. It's amazing because all of this stuff has been my intuition and watching the database for decades. So I've now been able to validate that these metrics are good. For instance, the 42% number, it came up with 41.17. So close enough, right? So just eyeballing it, the 42 to 48, all these metrics have been validated. So what I'm building in is the software is now going to talk to you and tell you I've built in probabilities, some other aspects. So now it's just not a flat piece of data. The data understands the history, the characteristics, what the probabilities are. And on that sheet that I put out last night, there's little boxes that would tell you trend phase, what's going on. Those are things that I talk a lot about in the newsletter as well, in the Substack. If you don't get the Substack, it's kendallreport.substack.com. I also have, for the data sheets, there's a full manual out there now. I think it's like 20 pages. So there's lots of data on how to use that. And I was talking to someone earlier today, and I was describing, I'm going to do some videos on how you can take and use, use Claude, almost only Claude, and so for it to be down is pretty disabilitating at the moment. We'll take a look before I move on. But my point is, I'm going to show you folks how to use the AI along with the products, the indicators, as well as the VPM slash WaveTech. So we'll get into that soon. Let me just check something and see if we're back on and see if I can log in right now. Hey, they are back up. So give me just a minute, and I will run the data sheet. So bear with me 1 second. Talk amongst yourselves just for a few minutes. Almost there, folks. We can move on here. Okay, thanks for that. Just took me a minute. So we'll see. It looks like everything's running. I'm sure everybody over at Anthropic's feeling much better. I'm not sure when it came up, but certainly in the last 15, 20 minutes. So when that gets run, we'll talk about it. So let's go through the technicals here on the markets. And one of the things I was discussing, if we come back and just go back to early last week, is that we're starting to see a move down. We got to the 21-day moving averages was the natural place for it to move down to. Then the discussion was we should get kind of a rebound, and then ultimately it looks like we got coming into the first week of June, which is scary, is very close, right? That's this Friday is the final trading day of May. And so we'll move on to June, and looks like we still have a flat forecast, but we still have some vulnerability to coming. And the big pivot number that I talked about, let me just bring this up full screen. This green dots here is 50. Let me bring this up so we can all see it. Over here, 56.57. This is that green dots that's right above me here. That is the key pivot. I don't think we're going to get anywhere near that level, but I do think, we went back, we basically tested the 200 again, and if we just zoom out, the interesting that's happening is we still had a rising 200 down here, this very bottom indicator. And that is being forecast to turn over. And I think that's a significant event. And I'll share some information. I'm working on an algorithm that I've been testing and trying to look at. It's called the nearest neighbor algo. And what it does is it looks for different types of patterns and aberrations and tries to predict when that next event's going to happen. And what was interesting that came out of that, I'll share this with you folks, is what came out of it was that the 200, the WaveTech 200, this longest term indicator, had the most accuracy in finding these events. And so when these crossover events happen, other things are happening, those are really big. So, and if you notice, the other indicators are very erratic compared to, you get some volatility here, but for the most part, the longer term is very smooth. So we're about, this is daily, we're about to cross over to the downside, which would mean the 200-day moving average is losing momentum and starting to roll over. The reason why when we came back and we bounced off of that number, the reason why that happened was because of this still elevated momentum that is behind that moving average. So we got that to blow up. It's strong enough. It bounced right off of that level. So we went through the 200 here on Friday, and we ended up closing right above it. Let me just bring these numbers up so we can see it. So the close on Friday was 58.14. And then as we came in over the weekend, we came in just a little bit lower, but then Trump started talking on Sunday. We blew up in the pre-market of Monday's holiday. So this is kind of a combination day, extended bar, and we get all the way up to the upper end of the RTX level, and which was 59.12, and that was a good number. Good. The sheet is run, so that is good. Just taking a couple looks here. I'll bring this up on screen in just a second. So what we're seeing here, though, in this pattern is everything's trying to normalize around this 200. All the moving average projections, everything's coming into its normalization. So while today felt wonderful, really all it did was put us back where we were 3 days ago. So it wasn't like, did we start a new trend? It doesn't look like it to me. It looks like this was literally a flop, and we got this move up to the, all that. Yeah, Green Garden, I'm going to reach out to you. I'm organizing the symposium, just so you know. So I'll be reaching out to you real soon. I'm going to get us all together finally. So so the algos are showing that we're starting to lose some momentum. We're actually at 0.05 on ppm1. So let me just publish this. I'll bring up the sheet here. See if everything's back to normal over there. All right, so let's go ahead and put this data sheet up here. All right, so I'll come back up. What we're seeing, it's kind of interesting what came out of the sheet. We've got 70%. We've been pushing 80 percentile bullish ranges. We got a 610 on the trends, and then if we look at what's coming out of this, ppm1 is at a 0.05, which is that ppm1 tracks the 10-day simple. ppm2 tracks the 21. If we notice, it's still at a 0.32. So when we went down and bounced off of that, that's exactly the characteristic that's being suggested. And anything over 0.25 suggests that value will hold, and it did, right? And then we still have ppm3 and ppm 200 is fading. One of the things that came out of last night's sheet, I don't know if you folks noticed that, there was a breakout trade that was done. Let me just see if I can grab and pull it over to you. Yeah, I think I can pull this tab over, and you can. Yeah, so this was last night's. Let's get down here to the. This was a trade that I wanted to point out. It was the highest probability trade that was issued on the sheets last night. RTX breakout, 59.12. Basically, that was the RTX. That was the extreme number of the day. It was saying if it breaks out of that, the target's 59.50. You put a stop at 58.70. Turns out we went to 59.41. So we didn't quite make it, and it was printing at 41 right at the end of the day. So make sure when you get the Substack, that you're reviewing these numbers, because that's what I call the Jim Cramer trade: buy high, sell higher. I was fascinated to see that trade work, and actually traded that breakout today, and it was amazing. Okay, and there was nice metrics if you're using my indicators, and you had like the 5-minute up, the guidance that you got out of that coming into that mode and that breakout was pretty substantial. And so I usually use a 5-minute chart intraday for intraday movements and pivot points. And so that was perfect. But we come back to earth here, but I wanted to show you that because those sheets have come out. And like I said, I was just showing you this data sheet here. This one's got R1 breakout, 59.64, target 59.92, which is that would be a new high on the pattern that we're experiencing right now. The S1 breakdown, so if it breaks below S1, 59.15, it's right now 35, target 58.88. So those are kind of the pivot points to watch. One of the things, like I told you, that goes on here on these sheets is just like I'm talking to you now, I will go in there and develop the whole logic of what's likely to happen, and then I will train the algos that are in the data sheets to think like that. So these are the breakouts. A lot of times we try to buy S1, sell R2. Sometimes that's the trade depending on the setup, and so just pay attention to those and watch them. Just make sure that you keep everything tight, on any of those trade setups. But just study them, get some confidence, and go from there. But as we look at this pattern, since we get the RTX sell, I'll get off of this in a moment, is that what we got here is a signal that the markets are going to go sideways for 1 to 2 days. We look at the data coming out. There's a fair amount of data. We've got housing, we've got labor data, we've got GDP, we've got a lot of stuff. I think most of this is pretty much built into the markets. What we don't have is, any of the rhetoric and noise that's going to come out of the White House. So that's the wild card that plays out there right now. And like I said, at least if we knew it was coming out on Tuesday at 2 o'clock, 1 o'clock, 10 o'clock, 10 a.m., whatever, at least we could plan it and show up and participate in the response. All right, so let's go ahead and take a quick, one of the things I said I would do, let's look at the weekly real quick because that's an important setup that's going on here. So the weekly basically shows last week we had not a full outside reversal, so we didn't trigger the 3-bar trade that I talk about, but we did have a reversal of a sort. And if we get an inside week, which as long as we don't take out last week's high and last week's low, and we stay inside that pattern, which would be, we're traded right off of this 40-week moving average that's coming through here. If we stay within the grid this week, that's probably going to be good. If we stay in that inside bar, then that's going to be not necessarily, it's going to make this a neutral week, and that would make sense based on what we're seeing here. So there's still, I think before we look at this, I think 60, just looking here, 61.46, that's a 200-point move from here, right? So almost exactly 200 points. So we got an all-time new high. I still think if we get that, if we were to get an all-time new high in the next week or so, which there's probabilities are moving there. One of the things I didn't discuss very well in the database is we're above 42% on the intermediate. I was talking mainly about the daily. So I'll try to go through that tomorrow, but just know that the database has actually turned to show a reasonable pattern out there. I'm just looking at the other screen. I don't have all the stuff I usually have up over there. So let's, so I just want that perspective out there. So let's move on. We'll stick with the NASDAQ here on a weekly, and we look at that same kind of configuration, a bit of an inside bar. Last week we did get a, let me just double check the numbers here, 21,386, 20, so we got we did get an RTX sell signal, so 2 weeks ago, last week should have been sideways to down. That's what we got. This week could be another week from this signal carrying through. If we look at the red dots, this is suggesting that we're rolling into this moving average as well. And this is a pretty typical pattern. And if we stall here, I don't think it matters if we make a new high here or not, unless they've got a handful of things. Meaning the White House, has a whole bunch of these actual deals in their pocket, and they're going to show up and they're going to pile, and everything's wonderful, and they rebalance the world and all that stuff. The other thing that could happen at any moment is there could be some kind of ceasefire, some kind of deal working with the Ukrainian situation, and diffuse a lot of those things there. If that happens, that's I don't even know how to make an analysis of what that would mean if the whole world, the rhetoric around the world would de-escalate, and I don't know what that means. I don't know. I would suspect it would be viewed as bullish, as an immediately bullish, longer term. I don't know those things. And the best way we'll be able to tell this is hopefully we'll get a decent setup so that the technicals and the quantitative will give us a little bit of a lead there. Take a quick look at the daily here. RTX sell signal, just like with the short term on the E-minis, sideways to down for 1 to 2 days, but we're still seeing the same configuration. We're seeing the two of the primary patterns, the PPM1 and 2, are showing a loss of momentum. Tells us we could come back and test the 200 again. The 200 is about to break its first derivative. So all of the same things that are happening in the S&P are happening over here in the NASDAQ with a little higher beta. I'm continuing to kind of do a contrast on the Substack. So when I cover the S&P, then I talk about the NASDAQ, because they are so similar in patterns, that I'm contrasting. The NASDAQ has a little higher momentum and other values that are suggesting that whatever happens will be a bit higher beta, a little more volatility on the NASDAQ than what's happening on the S&P. So the fact that we got STX buy sell signal, I'll get this right, RTX sell signals on the S&P and the NASDAQ will tell us that we probably have good unison here and maybe a little bit of drifting after today. We're going to have to digest even just today's rally. It was pretty interesting the way it traded actually today, and there was definitely a stampede. I think a lot of folks that came in felt left out from the weekend trade that I talked about. It was about a 1.2 bump over the weekend, and we come in, it's like, hey, you guys left me out. So we got another stampede of buying coming in to kind of fill that. I want to go to the treasuries next, and I think that this was, if you recall, going back to last week, this daily, I thought we'd come back into the 440 range, start to stabilize. I think there's more here, probably 430, more downside. You can see the momentum is clearly moving lower, suggesting we're going to come down at least to this 21-day moving average here. Let me just bring that value up. You see it over here. 439 is going to be the target there. I think we get below that, probably come into this 40-day moving average, 434, 435. So what we saw, and by the way, I meant to bring this up in the opening comments. Remember the bond crisis from last week? And I did a video the other day, what bond crisis? There was no bond crisis. Everybody took this bastard auction, which is the 20-year. Nobody shows up at that thing ever. It's sort of like a, I had a good analogy. I'm not going to use it, but that's sort of like an event that nobody shows up for, and then it doesn't go well. There's 3 people there, and everybody is going to build that up. Everybody that has traded in their basement or their bedroom that has a YouTube channel was screaming how the end of the world's coming. You saw it everywhere on Twitter. Oh my gosh. It's like I told you folks, you want to see what won't happen, go to Zero Hedge, go through all the headlines, look at all that stuff. None of that stuff ever happens. And so it's the same thing here, the screaming of the bond collapse. Now, if that was a 10-year auction, I would have been digging in and looking at it, but it was a 20-year auction. And those of you that have never been on an institutional desk don't know what that means. And all those people who are screaming don't know what that means. And this is what I told you, this was not it. I still have the mark on this 10-year treasury at 4.72%. If we break above that, there's something going on, and we're going to have to pay really close attention. What we did, though, is we got up to this mark over here. We got up to this mark here which was right here, which was 4.63, 10 basis points away from this event that I'm talking about. And we backed off immediately. Now we see it collapse back in, 20, almost 23 basis points in 3 sessions. So there was no systemic event that happened. And I know I've been on record for years. I can't even remember how many years, but it's been because I'm an bond trader. And what I'm just telling you is if we're one bad auction away, I've been saying that over and over, and everybody's like, oh, this is it. This is what Kendall was talking about. It was not. It needs to be a primary, and especially like something like the 2-year. If that happened on the 2-year, that would be incredibly disastrous. And I just want to step through one more thing here, as there's folks claiming there's a $7 trillion refinancing coming, and there is. But just know that only $2 trillion, 2.1, I say only, that's a lot, is new money that's going to have to be raised. And I can tell you with all the deals and just general economic growth that's happening at 1% to 2% across the planet is all it takes to fulfill the need for that extra debt. So the U.S. dollar is not going to collapse here. None of that stuff is going to happen. All the disaster scenarios, you can usually blow them off because, let's face it, if people are talking about this is the next black swan, you can't see black swans. That's why they're black swans, right? These are events that happen. I lived through 87. I would say I saw that there were issues around 87. I didn't predict the crash, but I did have the right position on when the crash happened. So I would say by doing the incremental looking forward, I did write a newsletter September 16th, 1987, that said, the risk reward in owning U.S. stocks was 0, get out. I wasn't predicting a crash. I just didn't see any rewards anymore beyond that point. And it was a significant point, and our trade book reflected that attitude. And that's all I was discussing today. When you're trading, all you're trying to do is get the math, that's everything that I talk about on the show, between the database and all the quants and all the indicators. You do the math, and then if you're willing to do enough math and understand it and believe it, that's where you start to take trades. And that's why what we're seeing right now, like on everything, you get to the end when you do the math, it doesn't add up. You don't have the disaster happening. And like I said, anybody that's traded for 4 years and made a couple of trades, and anytime somebody tells you the percent gain on their account, my favorite book in the whole world is How to Lie Through Statistics. And it's just like, yeah, if you have $10, you made 100%, you made $10. You just know they're padding. They're not giving the numbers, and it doesn't make sense. And that's kind of a millennial thing. I've seen that a lot. That's a good way to hype. We made 28% in one day, or 100% in one day, so just beware. But on this stuff here, when we're looking at the bond market, this is everything Ray Dalio said it was. This is the foundation of everything. Okay, this is second only to currency, and especially the way that debt has grown. So if something goes wrong here, it's a big deal, and you do need to pay attention here. And this is my my background being as a bond trader, and especially during I traded a lot when interest rates were at 25%, and the long bond, the 30-year bond, was trading at 16 3/4. Okay, so there was a lot of risk in the markets at that point. That was probably the last greatest buying opportunity of the planet. Anyway, the bond market is big. We did not have a catastrophe. We're normalizing back into the range now. So everything should stabilize in the next week or so. once you get all the nitwits out there that are claiming that the end of the world's coming and the banks are collapsing. So if the bank, just remember this, folks, if all of these folks that claim this, if they're still running a YouTube channel, they still are talking about their brokerage account, they don't believe one thing of what they're telling you. Because if they did, they would be in their bunker and their money would be hidden in a cold storage in Bitcoin or gold or something. You wouldn't be able to find them if they believed one word of what they're saying. So there's no advantage to playing on the end of the system. It's always been my argument. If I disappear and you find out I'm in a bunker, it's bad. I'm just telling you, no one believes that. But the bond market is not in peril. There is plenty of demand. We'll see as the auctions that are virtually every week come out. Like I said, primary 2, 5, we'll throw 7 in there, 10, and a little bit of 30. But the 2 to 10 range is the primary. I just needed to get that out there so somebody could hear it as we go forward. All right, let's do the Dower. What time we got here? Yeah, I'm going to do the Dower. Then we'll cover. We'll hit gold, and then we'll go to Bitcoin. So stay to the end because I think Bitcoin's getting very interesting. All right, so let's go to the Dower. If you remember last week, I said it looks like the Dower is starting to set up. This is daily, set a bit of a bottom here. The forecast, everything, it looks like it wants to improve. We're probably going to head back to 101, 102 on the Dower. So this is also confirmation of what I just told you. I just told you the interest rates are going to come down. The Dower is going to get bid up a little bit. All this stuff this scenario got played out pretty hard. And there's enough traders, enough people to believe that where cash flow went out of the treasuries, out of the Dower at the same time. And those two events in parallel can be very devastating. Now what we're seeing, Dower's coming back, the bonds are coming back. So when the bonds are declining, that means the prices are rallying. So this is how it should work. Okay, and there's not a lot to say other than they're both in sync, and so that they're reversing some of that negativity that was flowing around the markets. And like I said, this is a big fish. The bond market. This is the bigger market, which is the currencies. So currency, bonds. I don't even know where equity might be even further down the trail, but there's a lot of stocks out there, but the point is that all the money is currency and bonds. Okay, we're ready to move forward. All right, let's go to GC. We'll check out gold. Gold got hit pretty good last night, as you would expect. There's still some more sideways, and what I've been talking about gold is that we're kind of locked in this sideways pattern. We're whipsawing within the market grid constraints, so that's typically what you would expect to see from this type of configuration. So there's not really anything going on here. We'll go to next level here real quick, and we'll look at the weekly. This is that monster trend I've been showing you. So this is the monster trend that goes back to 23. What we're seeing here is not exactly what I was predicting weeks ago. I thought we are seeing it, but what we need to see a normalization. This last little move here back in April when gold shot up all the way to this reversal top here where we got up to, just want to get exact number, 3509, and we reversed this configuration that we're looking at right now. This right, just trying to get this screen to work for me. So this configuration we're seeing on the market grid is it's attempting to do it's attempting to normalize, but we've got so much volatility in the market, it's still getting these spikes all over the place. So as we break this down, this upward shape, this is a weekly chart we're looking at. This upward shape here is actually the primary trend. We're going to stay above this. I've said before, we actually spiked well below this a number of weeks ago. This was back on May 12th, 3 weeks ago. We got below the 10, but we spiked right back, and now we're following this 10-week moving average. You can see the red dot is saying you should be able to trade off of this number. So if you see this simple average number here, let me just get you a number, 3254. Anything that looks close to that, it's probably going to be a buy and a rebound. If we go back to the daily chart, and we go back to the daily chart, you see we got some Fibonacci targets coming out of here. We've got some momentum to the upside, but ultimately it still looks like we've got a shot at getting down to 3151. We'll see if that 10-week moving average can hold it, but I'll stay on top of this as we go forward. All right, this was, I took a look at this before we started tonight, just a quick review. And this is interesting to me because we just got a Fibonacci target down, and there's a new pivot. This is a daily. Number of things to unpack here. Let me just circle in on chart. So we got these 3 fib targets to the downside, 97, 90, 97, 8. We're going to round off 92, 4, 89, 139. I'm not predicting they're going to go there, but anytime I get new fib targets, I acknowledge them. It could be what we call an island projection where there's just one bar. If we trade back up above roughly, we'll probably trade back above 110, 461. That will be enough to kill this downward projection. We still have good momentum here. If we bring back we've got momentum waning, but we're still looking at positive numbers for a few days. But this is what I've been talking about, folks. We made the new high, and we didn't run to the, what was the highest level we got to here? 110 something, 111, 876. And I had targets 113, and then above 113, 120, 120, 124, and up to as high as 134. I still feel like we're going to go to the weekly chart here in a minute. I still feel like this is still a historic moment trying to reveal itself. And if we do not run here, and I told you before, I think that the market makers on the ETFs and the options and everybody that's hanging around this market now that didn't used to be around they're doing their jobs, but they're trying to take advantage of market inconsistencies, and that's what market makers do. And so what we're seeing here is we got the break to new high and immediate rejection. That's a warning sign, okay? So we still have kind of what I call a dragon head formation that can resolve to upside, but we start looking at the predictions of the algos, and they're suggesting that this is a little bit of problem. So here's going to be a couple numbers to watch closely. The 21-day moving average at 106, 106, that's going to be a number. I've marked just the natural numbers, 105 and 100 even. We've got it. We cannot break these numbers. If we do, it's a danger zone, and it's possible then for these Fibonacci numbers start to come into play. Not happening yet. We want to look at one more chart real quick before I finish for today's session. I want to show you these fib targets up here. So we have 3 fib targets, 134, 157, 175. Now, if you hold Bitcoin, that sounds pretty exciting. What we need, though, is the confirmation. We still have, this is something I talked about, we have until the end of the first week of June to start to continue to move higher. So we're not really seeing a big breakdown potentially until we get into July. So all of the conditions for higher prices are still working at that point. So that's what. So we have these projections. Indicators are still positive. We've got a few more weeks where this positive tone. These are very bullish positive tones, not a little bit bullish. These are really strong signals. So we still have everything in place at the moment to be able to get this to work out for us. Okay, that this is going to go to these next levels. If so, this is just watch these levels close. That 106, 105 zone breaks below that. That's going to set some weird potential in this pattern. So just make sure that you're paying attention to those numbers. All right. Let's see if I can take a couple questions here, see if there's anything out there. Yeah, won't be long. The small caps, I didn't cover the Russell, but I will tomorrow. So come back sounding 6. Russell, nothing's going to change there until the yield curve does. I've been saying this for 2 years and been right for 2 years. We rallied up to a new high. There's nowhere for the small caps to go. The structure of the yield curve needs to be completely different. You can't have the front end 4 1/4 and the back end 4 1/4. They need a steepened yield curve. That index is full of crap, bad zombie companies, and most of them are regional to smaller banks. Now, one of the things that could make that sector work will have nothing to do with that, but I know that I saw an interview. I thought it was a terrible interview with Scott Bressett and on Bloomberg that's out there, I think in the last week or so. And he was talking about how they're working with the smaller banks because they do a lot of the agricultural lending. There's definitely huge piece of the U.S. financial system, but they're all fragmented and they also depend on having the yield curve structured. And that's what kept the small caps under thing. Tom Lee is, the big advocate, how it was going to double a year and a half ago. And I was like, no, not yet. Until that yield curve changes, that's not going to happen. We need front end of the yield curve to be about 3/4 to 1% lower than the back end of the curve. That lets these banks borrow short and lend long and gives them spreads. Till that happens, not going to happen. We also need that mid-range of yields to be down for a lot of these companies still have high borrowing costs. And, maybe productivity, maybe some of these crazy things that are being built, like this monster server farm in Abilene, Texas. Maybe those kind of things can facilitate some of these things. But small caps in big trouble. I'm just looking at some comments here. Bear with me. Yeah, so EKS, you guys need to look at WaveTech if you're doing portfolio management like that. That's not. There's more to it than that. Uh, yeah, just real quick on that that comment on the portfolio, putting 0.5%, 1%. The way that you make money in portfolio management is concentration. So you're going to make 5 and 7% bets, and you diversify in the back end. If you look at every ETF, the front end is loaded. So you have the top 10 stocks. You get an ETF with 50 stocks. The top 10 stocks will have anywhere from 30 to about 40% of the bet. And the way that you make money is through concentration, not by diversification. One of my mentors, 1981, used to say diversification is the fastest way to moderate losses and moderate gains. If you want to make money in a portfolio management, you want to do some things really different. Now, we built in the WaveTech platform, we built a very unique way to allocate assets, but also not using stops, but looking at trend flow and money flow and things of that sort to be able to change our bets around and move our deck around of those 30 stocks and switch around who's got the biggest weighting and things like that. I took, what's his name, Tom Lee's latest portfolio and put it in there. We almost doubled the returns doing it our way versus Tom Lee buy and hold. I picked all the right stocks. Anyway, good question, though. A good thing to kind of trigger me off on. Let's see what time we got here. Yeah, we're over time. I'm going to look at one more. Yeah, and that's so. This is the thing, Mike. Unless you, that's another classic misnomer is that the banks are sitting on 500 billion unrealized losses. What you don't know is what they're. This is what I used to do. So now you're kind of into my world. Is most of those assets are hedged, even through portfolio within the bank, or outright hedged. So those losses aren't nearly what you think they are. The people look at the bonds and say they're underwater this certain percent. I've worked with banks. They were my customer, and I can tell you what that's not how the banks look. All right, we're going to call it there. I could interact. Good thread tonight, though, folks. Thanks for coming. Appreciate it. Make sure you hit the like button before you leave, and then also subscribe, all that stuff. That channel's actually grown again since I've been back for the last month and a half. Got some really exciting things they're working on, and I can't wait to get a couple of these things working and be able to show you what we're doing. So anyway, folks, thanks again for being part of this community. This is an awesome group of people. I love no trolls, no weird people. It's awesome. I appreciate everybody coming. We'll talk to you soon. See you tomorrow at the same time. Have a great evening.